Picture this: Omaha, Nebraska, in the mid-20th century. A young boy named Warren Buffett begins his journey to become one of the world's most renowned investors. Born into a family of stockbrokers, Warren's fascination with the world of finance began to take root at an incredibly early age. By the time he was 11, he had already made his first investment, purchasing 3 shares of City Service, an oil service company. In high school, he was more interested in making money than studying textbooks, turning his hand to various entrepreneurial ventures. From delivering newspapers to selling golf balls, Warren's appetite for business was insatiable. His early ventures gave him a taste of the investment world, and he was hooked. Warren's passion for investing continued to grow, and he went on to study business at the University of Nebraska. But it was not until the 1960s that Buffett would make one of his most famous investments in a company we all know as American Express. In 1963, American Express found itself embroiled in a scandal that would shake the company to its core. It was the Salad Oil scandal, a fraudulent scheme that would leave a lasting impact on the financial world, and particularly on American Express. The scandal involved a company named Allied Crude Vegetable Oil Refining Corporation. This company, a major client of Amex's warehousing subsidiary, claimed to have vast quantities of salad oil stored in its tanks. However, when inspectors arrived, they found the tanks filled mostly with seawater. The salad oil, which was collateral for loans, was a mere illusion. American Express, having issued warehouse receipts against the non-existent oil, was left on the hook for hundreds of millions of dollars. The scandal sent shockwaves through the business world, and American Express was at the epicenter. The company's stock price plummeted, losing half its value in a matter of months. The Salad Oil scandal dealt a significant blow to American Express's reputation. The company, once seen as a trustworthy and reliable financial institution, was now associated with one of the biggest business frauds of the time. The scandal also had a direct impact on the company's bottom line, as American Express was forced to pay out significant sums to settle claims related to the fraudulent warehouse receipts. The fallout from the Salad Oil scandal was immense. Investors, shaken by the company's involvement in the scandal and the significant drop in its stock price, began to flee. American Express was in a precarious position, its future uncertain. The company's reputation was in tatters, its finances strained, and its stock price at an all-time low. But amidst the chaos and uncertainty, there was one investor who saw an opportunity. An investor who, instead of running away, moved closer. That investor was Warren Buffett. With the company's reputation and finances in tatters, many investors fled. But not Warren Buffett. In the midst of chaos, Buffett saw an opportunity. A characteristic move for a man known for his strategic acumen and unshakable conviction. As the dust was still settling from the Salad Oil scandal, Warren Buffett made his play. He decided to invest in American Express, a decision that left many scratching their heads. But let's dive a little deeper into Buffett's thought process. His decision wasn't based on a hunch or a whim. It was rooted in his firm belief in the company's intrinsic value. He saw beyond the scandal, beyond the immediate crisis, and focused on the long-term potential of the company. Buffett was convinced that American Express had what it took to bounce back. Despite the financial turmoil and the loss of trust, he believed in the company's strong fundamentals. He observed the enduring loyalty of its customers, a solid business model, and a brand that, despite taking a hit, still held significant weight in the market. But why take such a risk, you might ask? Well, Buffett has always been a proponent of the idea that one should be fearful when others are greedy and greedy when others are fearful. And in the wake of the Salad Oil scandal, fear was high and American Express's stock was drastically undervalued. This was the perfect time for Buffett to make his move. He invested heavily in American Express, buying up a substantial amount of shares at a discounted price. It was a bold move, one that required a great deal of courage and conviction. But for Buffett, it was an opportunity too good to miss. This decision wasn't just a gamble, it was a calculated risk. Buffett had done his homework. He understood the company, its strengths and weaknesses, and he saw a clear path to recovery. And so, amidst the chaos and uncertainty, Buffett stayed true to his investment philosophy. He saw an opportunity where others saw disaster. He trusted in the intrinsic value of a company, even when it was under a cloud of scandal. Buffett's faith in American Express would not be misplaced. His bold move would go on to become one of the most iconic investments in history, a testament to his wisdom, foresight, and unshakable faith in value investing. American Express began to recover, slowly but surely. The company's leadership understood that they needed to regain the trust of their investors and customers alike, and they set out to do just that. The company implemented rigorous internal controls to prevent a recurrence of such a scandal. They also invested heavily in their customer service and product offerings, aiming to win back the loyalty of their cardholders. As these measures started to take effect, a glimmer of hope began to shine through the clouds of uncertainty. The company's stock price, which had taken a significant hit, began to inch upwards. The efforts of the American Express team were finally starting to bear fruit, and the market was responding positively. Warren Buffett, ever the watchful observer, was not blind to these positive changes. Despite the lingering skepticism in the market, he saw the intrinsic value of American Express and believed in its potential for recovery. His conviction in the company only grew stronger, and he began to increase his stake in American Express. As the years rolled on, American Express not only recovered from the scandal, but also managed to thrive. The company's stock price soared, and it once again became a respected player in the financial services industry. Investors who had initially fled from the company now clamored to get a piece of the action. Buffett's faith in American Express was rewarded handsomely. His initial investment multiplied many times over, contributing significantly to the growth of his wealth. His investment in American Express became a shining example of his value investing strategy, demonstrating the power of patience, conviction, and a keen eye for undervalued assets. Now, let's fast forward to the present day. American Express has firmly established itself as a leading global services company, providing customers with access to products, insights, and experiences that enrich lives and build business success. The company's stock is a staple in the portfolios of many investors, including that of Warren Buffett. Today, American Express is one of the largest holdings in Buffett's portfolio. Buffett's investment in American Express teaches us several valuable lessons. Moving beyond the specifics of the American Express story, let's dive into the broader strokes painted by Buffett's investment strategy. The first and perhaps most significant takeaway is the importance of recognizing value. Buffett didn't just see American Express as a company in crisis, he saw a company with a strong brand and a loyal customer base. He understood that the salad oil scandal, while significant, didn't destroy the company's inherent worth. This is a vital lesson for all investors. Look beyond the surface, beyond the immediate crisis, and try to discern the enduring value of a business. Next, we have the principle of patience. Buffett didn't expect an immediate turnaround for American Express. He knew it would take time for the company to recover and regain its standing, but he believed in the company's long-term potential and was willing to wait. This patience is a hallmark of Buffett's investing style. In a world where many are looking for quick wins and instant gratification, Buffett's approach is a refreshing reminder that good things often come to those who wait. Moreover, Buffett's investment underscores the importance of staying the course during tough times. It's easy to panic and sell when things go south, but Buffett held on. He had faith in his analysis, faith in the company, and he wasn't swayed by the doom and gloom of the moment. This steadfastness, this refusal to be swayed by short-term fluctuations, is a powerful lesson for all investors. Then there's the matter of courage. It takes guts to invest in a company when everyone else is running for the hills. Buffett's boldness, his willingness to swim against the current, is a testament to his conviction and his confidence in his investment strategy. It's a lesson in not being afraid to stand alone, in not being swayed by the crowd. Finally, Buffett's investment in American Express illustrates the importance of due diligence. He didn't blindly jump in, he did his homework. He studied the company, understood its business model, evaluated its prospects. This thoroughness, this attention to detail, is yet another critical lesson for investors. So there you have it. From recognizing value to demonstrating patience. From staying the course to showing courage. From conducting due diligence to investing with conviction. Buffett's investment in American Express offers a masterclass in investing. As Buffett once said, price is what you pay, value is what you get. And in the case of American Express, value is exactly what he got. So, next time you're considering an investment, remember these lessons from the Oracle of Omaha. They might just help you spot the next American Express.